Okay, we will get started. Thank you so much, everybody, for joining us this evening for our Gaucho Academy. This evening's event is Tax Prep 101. Would like to thank our sponsors for the Gaucho Academy series, American Pacific Mortgage. We're incredibly grateful to be joined today by our two panelists. I will introduce them shortly, but want to let you know that we will have a chance for Q&A. Please place your questions in the Q&A box, and those will be moderated. And I'd like to thank my incredible team, Julie, Arushi, and Sharkanosa, for helping to put this event together. So first and foremost, I would like to introduce our panelist, Bridget Foreman, class of 1991. Bridget is a partner at Bartlett, Pringle, and Wolf, LLP. And we have our alumni board director, Michael Desmond, class of 1990. Michael is a partner at Gibson, Dunn, and Crutcher, LLP, and co-chair of the firm's global tax controversy practice. So we're incredibly grateful to have them today, and they've developed some really excellent content to go through. So we're going to move through quite quickly. As I said, if you've got any questions, please place them in the box, and we'll have time for Q&A at the end. And also, this session is being recorded, so we'll make the recording available shortly. So thank you to Bridget and Michael. I will hand over to you.
Great. Thank you, Samantha. If we can move to the first slide. And thank you, everyone, for joining us here this evening and for inviting me to come and present alongside Bridget Foreman. This is a very timely presentation. The IRS just announced recently that it is opening the filing season on Monday, January 29th for 2023 returns. So those of you who happen to have all your tax documents and other materials in order can start filing your returns starting next Monday. That may be a very small number of you, but nonetheless, the filing season does start and is open by the IRS starting on Monday. So we're going to try to give a very high-level overview of some considerations and thoughts around filing your 2023 tax returns and some current issues and developments and things to be thinking about. I think this is the second slide. Could you just go back one? I may have the order wrong. We wanted to talk, go back to the very beginning. There we go. So just to set the stage for our discussion today, we wanted to talk about the income tax system generally and give you a framework for what we'll be talking about. As this slide indicates, the tax law has grown exponentially in recent years. It's now about 10,000 separate sections of the Internal Revenue Code, about 7,000 pages of text just in the tax law itself. So a lot of different provisions to keep in mind there. Recently, much of that growth has been in the area of what we call tax expenditures. So provisions in the tax law that actually provide a benefit to taxpayers are not necessarily revenue raising. They're not provisions that collect tax from people. They give benefits and even tax credits and refundable credits that are essentially the form of cash back to individual taxpayers. And those cover a wide range of what I call kind of socioeconomic issues. So there are tax code provisions dealing with education incentives and retirement incentives and healthcare. More recently, a number of clean energy provisions, which we'll talk about. So a wide range of different incentives that are built into the tax law, and probably the things that you're more interested in learning about than the provisions that call for payment of taxes. So in addition to all of those tax expenditure provisions, the IRS still does collect almost $5 trillion a year in gross tax revenue. So there are all the aspects of the tax law that deal with the collection of taxes as well. All of that amounts to what can be sometimes a bit of a headache in getting your tax return prepared. And that's what we're going to talk about here today. So I will turn it over to Bridget, but just one other contextual comment. I am a tax attorney, as was introduced. So my role in the tax system is a little bit different than Bridget's. I am not a CPA. And if you find yourself talking to me, you're probably in trouble for one of two reasons. One, that I'm preparing your tax return and I should not be preparing your return. And the other is that you're under audit. And that's more of the work that I do, is handling representation of clients when they're under audit by the IRS. So either way, Bridget's probably the one you want to be talking to more than me. And she has a little bit more experience in the actual preparation of tax returns, being from the accounting side of the house. But I do work very closely with accountants, including with Bridget on a number of matters. So I think the two of us together can hopefully give you some good perspective. So that's a very quick overview of the federal system. I know we're going to talk briefly, Bridget, about state income taxes too, which won't be a focus of our discussion here today.
Yeah, thank you. So definitely the main focus of this entire presentation is the federal tax system. But we do have to always remember that you have to file both federal and state tax returns. You have to file a state tax return in the state which you're a resident in, and that state will tax you on your global income. And then sometimes you also have to file in other states if you have income sourced to those states as well. You have to file non-resident returns. So the state income tax component can often be as complicated as the federal. And the one thing to really note is that state conformity is not automatic. So what do I mean by that? State or federal tax laws change almost every year. There are changes, some huge changes. We'll mention, throughout this presentation, we'll refer to the 2017 Tax Cuts and Jobs Act, or TCJA is how we like to refer to it. And that was a sweeping tax legislation that really changed a lot of the tax code. And not all the states conform to that. So, for example, I always like to use California as an example, the home state of UCSB, and also one of the most vexing states to file taxes in. California conforms to the 2015 federal tax code. So 2015 was the last year that California said, okay, we're going to follow all the tax laws that the federal has put forward. So when we have sweeping tax law changes or tax acts, as we did in 2017, California did not play along. They would pick and choose what they wanted to conform to and what they didn't. So you end up filing basically two different returns under different rules. So it's just very important to kind of understand what your state does, whether they automatically conform by statute. Those states are really great. And for those that don't, to understand what the specific rules are for those states so that you are taking tax advantage where it's available.
And Bridget, you made a good point about sometimes being subject to tax in more than one state. Certainly partners and partnerships can have activities in different states. The other thing that might be also relevant, particularly for recent graduates who are maybe moving out of state, is that you can, if you move between states, you may have to file multiple state returns there as well. So it's important to keep track of where you're earning income, to let your employer know that you're moving. If you're moving between states, to be sure that your withholding on taxes and on your income is key to the state that you're actually living and working in. And if you move, that is information that's known to your employer and they know what state you're in, so the right withholding can be done, assuming it's in a state that does have an income tax, which most states do, as Bridget said.
Right. And the follow-up on that is that, one of the good things about the states is that they all kind of work together and they play together. So if you're filing in one state as a resident and they're taxing you on your global taxation or your global income, and then say some of that income is sourced to another state, like Georgia, California will give you credit for the taxes paid in Georgia to try to eliminate the double taxation. But overall, you will end up paying the higher tax, but whichever state has the higher tax brackets, that's what you're going to be paying overall. So you can't reduce your taxes by spreading it out over various states. So if you want to move to the next slide. Okay, so just to kind of continue on the general overview. So, April 15th is the tax due date that everyone knows. That is the due date where your individual tax returns are due. April 15th is also the due date for C corporations and for trust returns. There's also other due dates that you may need to be aware of. Passive entity returns, including partnerships, LLCs, and S corps. Those are all due on March 15th. The reason being, this was a change that was made during my career. And it was for trying to get the IRS was trying to get pass-through entities where the taxation is not at the entity level, but actually pushed out to the owners of the entity to get those returns done first, so that the information can then get to the ultimate owners so they can include it in their tax returns. So it's a two-step process. there are extensions available. This is a lot of work to get done in just a couple months' time. So you can extend your returns for a 6-month extension. Some states allow a little bit longer, but for federal, it's a 6-month extension. But you need to remember that that's an extension to file, not an extension to pay. That means if you end up owing tax at the end of the year, let's say you file your returns and you've paid through withholding, maybe you've made some estimated tax payments, but you underpaid during the year, and you file your return and you still owe some tax, that needs to be paid by April 15th. If it's not, then you pay it with the filing of your return whenever that happens, but you will be subject to late penalties and interest. So very important you can't just file an extension and deal with it over the summer. You still have to do some calculations during this first quarter to make sure that you get that done correctly. Beyond that, go ahead.
Right, Bridget, the failure to pay penalties can really add up. So if you don't actually file your return until October on the 6-month extension, you can have a very significant failure to pay penalty if you owe a lot of money that should have been paid in April. There's also interest now running, and for many years it didn't matter as much when interest was 2 or 3%. It's now 8% on any underpayment of tax, so that can add a fairly hefty bill on top of the failure to pay penalties if you wait until October to pay any balance that's due on your tax return.
Right, exactly. Yeah, it can get a little frustrating. No one likes paying their taxes, and in addition to that, to also paying penalties and interest is not something that most people are excited about doing. So it's good to get those payments in early. When you get started to, okay, now I'm going to get ready to get my returns done, the main thing you have to do is collect all of your information. And one thing that we always highlight is that you need to gather all the third-party reporting. Now, what I mean by that is your employer, if you have an employer who's giving you a W-2, a copy of that W-2 is going to the IRS. So that's considered third-party reporting. There's also 1099 reporting. Let's say you are getting interest on a bank account, you get a 1099 INT. If you're a sole proprietor, some of your clients may be paying you and issuing you a 1099 non-employee compensation, an NEC. If you have investments in a brokerage account that's earning dividends, interest, capital gains, that's a 1099-B. So all of these reporting requirements, the third party, they're reporting to you what you made, but they're also sending a copy of that to the IRS. So when you file your return, at a bare minimum, the IRS expects to see all of that income on your return. So it's very important to make sure that you've got all of that together. There is, if you're not sure, let's say you've been waiting for a 1099 or a K-1 and you've done everything you can and you cannot find it, the IRS does create an account for every taxpayer where they enter the information that they receive from third-party reporters, and you have access to that. So there is a way to go onto the IRS website, create an account, and then you pull a transcript that's called a wage and income transcript. So oftentimes I know in my practice, when we have clients that travel a lot or seem to lose their mail, we will go to the IRS to see what they have to make sure that at a bare minimum, we're gathering everything that the IRS is already aware of. A caveat on that is that the IRS does put a big disclaimer on there that it may take several months in order for their file to be complete. So you can't, if that's what you're going to rely on, you cannot really pull that in March and assume that everything's there. So usually if we are looking at those are some of the returns that we extend. We make a payment, we extend, and then we pull it kind of further along towards the October deadline to make sure that we have all the information in there. We do have a link for where you can set up your account to pull those types of transcripts at the end of the slide presentation.
And we'll talk about this later, but keep in mind also that just because income is not on a 1099, that doesn't mean it's not subject to taxation. Sometimes there's this misnomer or thought that if you didn't get a 1099, it somehow doesn't need to be included on your return. I make that point in particular because some of the People that I see getting into the most trouble with the IRS are people that have large amounts of cash income that isn't picked up on 1099. The IRS has numerous ways of finding out that you had that cash income anyway. Whistleblowers, people that don't have a particular affinity for you and want to report to the IRS that you have unreported cash income. Those can often lead, particularly in higher dollar amounts, to very significant penalties, even criminal charges, when people fail to report cash income. And the explanation that you didn't get a 1099 is not one that holds much water. So be sure you're keeping track of other income, independent contractor income that's not reported on 1099s. Generally, there's a $600 threshold for a 1099, but there is no threshold for taxable and gross income. So $10 in independent contractor income is going to be taxable income, whether you get a 1099 for it or not. So just a minor public service message there to keep track of that as well.
Yeah, absolutely. Absolutely. We deal with some of those audits as well. And it's not fun when the IRS agent is looking at your bank accounts and asking about every single deposit to see if it's actually income or not. It's
just an anecdotal story to tell you how creative the IRS can be. There was a program some years ago to audit laundromats that often aren't reporting their income because it's all in coins that are put into the laundromat, into the washing machine. So the IRS would go and get the water bills from the state and say, well, we know how much income you're making in cash because we can measure the amount of water that you're using in your washing machine. So there are lots of ways to reconstruct income that do not rely on 1099 that, as I said, in the higher dollar amounts can get you into significant trouble. So keep track of your cash income as well, and be sure you're telling your tax return preparer that you've got those sources of income.
Yeah, absolutely. And talking about tax return preparers, so that's kind of the next part of this slide is, so you've got all of your information together and what do you do with it? And really there's, two ways to go about it. You can do your own, it's actually at the end of the last slide, but you can do your own return. And there's lots of software out there. DIY software is what I call it. You've got TurboTax, H&R Block, TaxSlayer. There's a whole lot of different options out there. Many of them are very, very good. And the nice part about them is most of them kind of lead you through the process. They do almost like a Q&A format where they're asking you, did you get wages? And if you click yes, then they give you the screens where you can add in, your W-2 information. Do you own a home? If you click yes, they might ask you about property taxes that you've paid or mortgage interest. So they are good. And if you don't have a high level of complexity, that might be the way to go. They're relatively cost efficient. A lot of them do have, kind of a live chat feature or a call a professional feature to help you with things where you might have questions. I know that I've reviewed some returns that have been self-prepared by people that have come into me. And usually if there are discrepancies between what I would have prepared versus what they did, on their own using something like TurboTax, usually it is something that's more nuanced because they do have that extra layer of complexity in their returns, or that they've entered the same information in multiple places. So, where they have mortgage interest, for example, and I realized that they put it, as investment interest and they put it as qualified home mortgage interest. And then they actually thought that that's what they're asking a question about interest income. So they had this same number all over the place, which was incorrect, and it provided an incorrect result. So just making sure you're entering information once, not more than once, and you're just following the process and taking your time. Now, if you don't want to take the time doing that yourself, it's either just not a fun Saturday, Sunday for you, or you don't have the time, or you do have more complexity, then definitely work together with a tax preparer. There are many different tax preparers out there. There are CPAs, in large firms, small firms, sole proprietors. There's also enrolled agents and other certified tax preparers. So usually what I tell people is to get referrals from people that they know and trust. That's usually the best way to get started in finding a tax professional to work with. But then I also recommend taking that extra step of making a connection, having a meeting, if it's on the phone or on Zoom or in person, and getting to know a little bit about this person that might be helping you prepare your returns. Tax returns share a lot of individual information. So you want to make sure that this is somebody who you believe you can trust and that you feel, is going about it correctly and is going to be diligent about what they're doing. And also make sure that it's somebody that you can communicate with clearly. So it's amazing how much of just the personal interaction, you need to make sure that it's someone, if you give information, that they're actually going to hear you and take it off. And there are personalities that clash and don't work well both ways. So really making sure that that's a good piece. And then finally, I'd say, right sizing the engagement. And what I mean by that is, if you are a wage earner, you have a W-2 and maybe some bank interest income, you don't necessarily need to go to the Big Four and work with a CPA there whose rates are going to be much higher than, and the services that they provide are really services that you don't need. So you want to make sure that the, I guess the pricing method of, how they invoice for their services matches with your budget and your expectations, and it matches with the value that you're getting from the engagement. So if you just want a tax return and then I'll see you again next year, that's very different than working with someone who's going to, yes, be providing returns, but is also going to be working with you, throughout the year. If you're working on estimated tax payments or maybe some strategy around a transaction that you're doing, that's a different engagement. That's going to be a different professional that you're working with.
Do you want me to start with the statute of limitations issue, Bridget? I know we talked about just.
Sure.
Next slide there talks about how long the IRS has to make adjustments to your tax return. Yeah, that slide there. So typically after you file, the IRS has 3 years to come back and make adjustments or conduct an audit and conclude the audit. That can get very involved if you actually have a full-blown what's called an office audit, where an agent comes to you or you go to the IRS's offices to have a full-blown audit. Those are few and far between. Far more often you will get notices from the IRS, which are sort of a mini audit, what are called correspondence audits typically. And that's where they find maybe you had a W-2 that you neglected to report on your tax return, or a 1099, or there's a computational issue. So the IRS's computer systems do a decent job at identifying discrepancies on returns and information reporting 1099s or W-2s that aren't picked up on the tax return. Bridget spoke about that earlier. That is typically done within a very short period of time of filing the return. Within a couple of weeks or even a couple of months, you'll get notices from the IRS. It's very important to pay attention to those, because if you ignore them, the IRS assumes the worst and will assess tax against you and send you a bill. And you will oftentimes lose your ability to contest that without first paying the taxes, or at least some challenges to contesting that. So if you are getting notices from the IRS, oftentimes they're misplaced and their computer systems don't understand why numbers aren't matching up, and a simple explanation can help. But it's very important to open your mail from the IRS and respond to it promptly, because otherwise things go off onto autopilot, and it's very hard to unring those bells once the IRS has started assessing taxes, sending out collection notices. But the general period is 3 years. There are some exceptions to that. If you haven't filed a return, then the clock that the IRS has to make adjustments never starts running. So it can be 3, 5, 10 years down the road. If you haven't filed a return when you had one due, the IRS can still make adjustments and come back and open up and examine that tax year. Also, this mentions here that 25%. So if you understate your income, so you had a bunch of cash income that wasn't picked up on your return, and that's more than 25% of what you should have reported, the IRS has 6 years to go back and adjust that return. And a number of other exceptions. If you file for bankruptcy, that can extend the time period the IRS has. If you enter into a payment plan with the IRS, that can also extend the time the IRS has to adjust the time, or to adjust the return. But it's typically a period of 3 years to do a regular audit. But as I said, for the most part, those notices come in and you'll have correspondence and correspondence audits much, much sooner than that, within a few weeks or months of filing the return. The final point there is just about the collection limitations period. So if you file a return that reports that you owe taxes and you don't cut a check to the IRS or make a payment with that return, that will be what's called a self-assessed tax. and the IRS has 10 years to go back and collect that. Also, if the IRS adjusts your return after an audit and says you owe more than you reported, they will ultimately assess that, which is a formal procedure for putting that on the records and making that a formal bill due from you. And once that assessment happens, the IRS again has 10 years to collect on that. That period can also be told by the filing of bankruptcy and other things, but generally it's a 10-year period.
Right.
Did you want to talk briefly about record retention, Bridget, as well? And
yeah, absolutely. And then also just, again, states don't always conform to federal. So often the states will match all of these statute of limitations or make them a little bit longer. So again, our favorite state of California adds a year to it. So instead of 3 years, it's 4 years. And, you know, states will do that often in case an IRS audit starts up maybe kind of close to that 3-year time frame. The states have a little extra time to jump on the train and see what they're looking at. So again, kind of keep mindful of that. And that does lead us into record retention and permanent record guidelines. So we get the question often of, you know, what do I have to keep? Do I have to keep the backup for my tax return, or is it just keeping a copy of my tax return sufficient? You know, and if I do have to keep information, how long do I have to keep it? So the simple answer to that is yes, you need to keep all the records that you use and work papers, scratch notepads, whatever you have to populate your tax return, you need to keep in your possession until at a minimum, the statute of limitations closes. And that's because if you are selected for audit or examination, you'll be asked, you know, where did this number come from? And you're going to have to produce something to show, you know, where the income came from. It's more often the deduction side, you know, where do these deductions come from, or why is the income on your return a certain number if the IRS thinks it should be something else. You no longer need to keep that in paper format. So we often, you know, recommend for our clients to just scan it all in a big PDF file or, you know, some other electronic files. At least then you're not, you know, having a whole storage bin of paper in your garage or closet somewhere. And then the other item for that is permanent records, and I have permanent and semi-permanent records. So not only should you keep information through the statute of limitations, but you should also keep any information on items that might be on future returns. And so an example of that is, let's say that you have a business and you have a loss. So it's called a net operating loss, and your loss exceeds your current income for that year. So you have a net operating loss that then rolls forward to the next year. And you can use it to offset income year after year until it's exhausted. Well, if your net operating loss, you know, has not been exhausted and it's been, you know, 5 years down the line, and then that 5th year gets audited, the IRS can and likely will ask you for documentation to support how that loss was generated. So the loss was generated on a return where the statute's already closed, but you still need to keep those records. So anything that is kind of informing a future return, you need to hold on to until it's no longer part of your life. Finally, permanent records are also records that maybe aren't part of your return today, but could be a part of your returns tomorrow. An easy example of that is, let's say you purchase a home. The actual purchase of a home in itself is not a taxable event. So that purchase of the home is likely not going to be on your tax return in the year that you purchase it, but you'll want to hold on to that closing escrow statement saying what you bought it for. And were there any other expenses associated with the purchase of that home? Because if you sell it 20 years down the line, you're going to have to calculate your gain on sale. And part of that calculation is, what is your historical cost? Well, your historical cost is evidenced by that closing escrow statement from 20 years before. So any documentation for larger assets, larger, you know, investments that you make, definitely keep those in a nice little perm file somewhere, because they may become important later on for your tax filings.
And just another example on the home, the main residence or principal residence. when you ultimately sell your house, you can get an exclusion of $200,000 or $500,000, $250,000 or $500,000, depending on how you file. And that can be years and years down the road. And that number is not indexed for inflation. So owning a home in California, it's not that hard if you own it for more than a few years to have $250,000 or $500,000 in gain. But if in the meantime you did a significant renovation and spent $100,000 on a remodel, that can be added to your basis, and that's excluded from your taxable income on the sale of the house, assuming you've maintained proper records of it. So as Bridget said, any of those kind of long-term, permanent, significant improvements to property, keep track of that. Otherwise, you could be paying tax on that at the back end if you don't have the right records for those improvements made, maybe years or decades before you actually sell your house.
Thank you. Okay, so let's just talk a little bit about the return itself. And so, Mike, did you want to start
Sure.
on income?
So the next slide there, I think, picks up on some of the income issues. And we talked about this briefly before, but very broad definition of gross income under Section 61 of the Internal Revenue Code, for those of you who are fans of the Internal Revenue Code. So just about any ascension to wealth or accession to wealth is defined under the tax law as gross income. Lots of exclusions from that, but that's the base. So that can mean a whole bunch of things. People give you in-kind property. If you're paid in property or services, so barter transactions, those kinds of things, all subject to a very broad definition of gross income. Once you kind of define what your universe of income is, we'll talk about the standard deduction and itemized deductions, but you ultimately end up with taxable income, which is taxed at what are called progressive rates, depending on how much your income is, ranging from 10% to 37%. That's the current maximum individual income tax rate. And again, this is just federal. So California adds a very significant, basically 9 to 13.3% tax on top of that, but this is just federal. Some types of income get preferential rates. So the most general example is long-term capital gains from the sale of investments are typically taxed at preferential long-term capital gain rates. You have to hold those investments for more than a year. And it's not all investments, but most investments are subject to a long-term preferential capital gain rate. Some dividend income off of stock can also be taxed at preferential rates. Those rates are typically 20%. For some income levels, it's lower, so they're even more. At some income levels, 0% capital gain rates and preferential dividend rates. But for certain types of investment income, there are preferential tax rates there. We talk about capital gains there. There are a few very kind of technical rules around what is a capital gain, what is a capital loss, when are the losses allowable, not allowable. And we touch, I think there, Bridget, on the worthless securities, wash sale rules. Those are all different technical rules that come into play. Sometimes when you're trying to recognize a loss, like cryptocurrency, is very volatile, obviously. So a lot of people have had losses, if not this year, then the year before. When are those allowable and not allowable? What types of income can those be used to offset the loss against? Those kinds of issues come into play with certain types of investment property and other kind of capital assets, and stock or cryptocurrency being a good example.
Right. And on that, the point that I wanted to kind of bring up on that is the wash sale rules. I mean, in short and sweet, the wash sale rules say that if you have a security and you sell it at a loss, you cannot buy the same security or substantially the same security within 30 days of the sale. And if you do, then you don't get to recognize the loss. So it's basically set up so that taxpayers cannot manufacture tax losses without having an economic loss as well. Example, you buy something for $100 and on the stock market and it devalues to 10. If you sell it at 10, now you've recognized a $90 loss. But if you immediately buy it again at 10, you still have about the same number of shares. So you really haven't lost anything. You just rode the wave down. So in that case, you would not be able to recognize that $90 loss. That loss would just be kind of carried into your next your next transaction. So that's what the wash sale rules are. The nuance right now, and I say right now because I do expect it to change as cryptocurrency is more regulated and more defined. But right now, cryptocurrency does not fall under the definition of a security. So cryptocurrency is the one place where you can actually sell it and then buy essentially the same thing, and you do recognize the loss. And I guess I would just, kind of note to the wary, I'd be careful about playing with that too much, the way cryptocurrency fluctuates so much. I think it might be a little difficult on the timing to really achieve that, but that opportunity is there.
And 2023 was generally a positive year in the securities markets, and I think even the cryptocurrency market. But there are years, obviously, when investment assets drop precipitously. And even if you've got a building or something that you own that's lost a lot of money, one general rule to keep in mind is if you have a significant capital loss, that can only be used to offset your ordinary income. So if you're making $100,000 in ordinary income and you have a $50,000 capital loss because you sold a building at a loss or you sold securities at a loss, you can only use $3,000 of that capital loss to offset your ordinary wage income. And the rest of it you can carry forward and use to offset capital gains in future years. But if you lose a bunch of money in the markets or in your real estate investments, you're very limited in the amount of that loss that you can use to offset your ordinary income, your wage income, your compensation income, those kinds of things. That's been $3,000 for years. It hasn't been indexed to inflation. Congress hasn't seen it appropriate to change that number, but it's a very significant limitation on investment type losses and what you can use those for.
Right.
So the next bullet point here is just Social Security taxes. To keep that in mind, we've been talking mainly about income taxes, but wage income is subject to Social Security and Medicare taxes as well as employment taxes on the state level. For people who are just wage earners, particularly at the lower income levels, the Social Security tax can be sometimes the most significant tax and withholding that you will see on your W-2. So there are two parts of that. You pay 6.2% of your wages up to, I think it's $160,000 as a Social Security wage cap. And your employer also pays 6.2% up to that wage cap. So if you're only making $20,000 or $30,000 in wage income, you're going to be hit both individually and through your employer with about a 13% Social Security tax on that, and almost no income tax under that progressive 10% rate that we talked about before. So that's why you'll sometimes hear stories about Warren Buffett paying higher rate of tax than his secretary, usually because his secretary is paying a lot of Social Security taxes relative to his or her income taxes, whereas Warren Buffett is paying at that preferential 20% on his dividend and capital gain income. But Social Security tax is something to keep an eye on, and that was something that you will see as a big number on your W-2. In theory, we all get that back as Social Security benefits when we retire. Some of us wonder whether there will be a pot of money there to pay us our Social Security benefits when we retire. But in theory, that's how that's supposed to play out. So it's sort of like a tax, but it's also amounts that you're supposed to get back when you retire as a retirement benefit.
And then I'll jump in on the independent contractors, self-employed earnings. That's another big piece. If you have a trade or business and you're sole proprietor, so you're not working for somebody else, but you're running your own business, all of that is also reported on your individual tax return. So if you're holding yourself out for business, you can deduct business expenses against your gross income to get to what your net self-employed earnings are. So again, this is where documentation is very important, and to make sure that your business expenses are true business expenses. It is a highly audited area. As you know, the IRS, I think rightfully so, takes the position that sole proprietors might, kind of throw in some of their personal expenses and call them business expenses and see if anybody catches it. That's a little trick of the trade that I think has been overused and abused, and the IRS is very aware of that. So be very careful, have very good records on self-employed income and expenses with that. And then the self-employment taxes on that, similar to what Mike was just talking about, the Social Security tax and Medicare tax, or both of those, as your wage earner, as he mentioned, you're going to pay half and your employer's going to pay half. Well, if you're self-employed, you get to pay both halves. So in addition to paying income tax on the net income that you're earning through your business, you're also paying 15.3% of self-employment taxes on that net income. The 15.3%, again, that's 12.4, which is the Social Security, and that is capped at 160,200 for 2023. So beyond that number, you're not paying any more of that 12.4%, but the Medicare tax is 2.9%, and that will be on your entire earned income. So if you have a business, but you also are an employee as well, so you have a W-2 as well as your self-employed business, that that cap on the Social Security, you add all of your earned income together, so you might hit it a little bit faster because your employer is already paying some of it, which is great. Medicare taxes on all of it. And if your earned income exceeds certain thresholds, there's an additional 0.9% Medicare taxes then tacked on. So again, more taxes, not just income taxes, but they're all kind of reported and paid through the same mechanism of your individual tax return. Finally, I had a little note here about contrast to casual income. Casual income is when you're receiving income for services, but you're not holding yourself out to have a business. An example I like to give is, let's say you have a career where you are a chef, and that's where you make your money. Maybe you're employed by a large restaurant and you're getting your wages, but you also like to doodle on the side and you've gotten pretty good at it. And a friend of yours approaches you and says, hey, I love what you're doing there. Can I pay you, $500 to paint me something so I can put it in my living room? And you say, yeah, great, love to do it. An extra $500 would be wonderful. So you're not holding yourself out to be in the business of being an artist, yet you're providing a service and getting money for it. That $500 is taxable income and needs to be reported on your return. Because it's casual income, the rules are is that you cannot deduct expenses against it because you don't have a business. So there's no expenses to go against it. You can't expense your paint and the canvas and whatever other expenses you incurred for that. But it's also not subject to that 15.3% self-employed tax. So, the good and the bad, but at the end, it is taxable income. It's just treated differently than that of an independent contractor.
And we talked previously about paying taxes, which is a very important point for self-employed people because you don't have withholding like a wage earner does on a W-2. You don't see a paycheck that has withholding on it. So that can lead to a number of different issues with payments. So you really have to be very focused on paying estimated taxes. Otherwise, you might be hit with a very large bill come April 15th and even estimated tax penalties. So self-employed people, content creators, drivers for Uber and Lyft have to be very conscious of the amount of money that they're making throughout the year and ensuring that they're making estimated taxes, something that most wage earners who receive regular employment compensation don't need to worry about as much.
Right. Okay, great. Let's move to the next slide. And I realize that we are running a little behind. So I'm going to hit this one kind of quickly so we can get to some more exciting things. But we do need to talk quickly about deductions. We've talked about what is income. Let's get all your income. Let's make sure you include all of your income. What do you have to offset it? And that's your deductions. We talk about above the line and below the line deductions. The difference being, like, what is the line? The line is your adjusted gross income. So next time you happen to look at your 1040, on a quiet Saturday night, you'll see that you have all of your income and a couple adjustments, and then there's a line that says adjusted gross income, and then below that is where you have your itemized deductions or a standard deduction. the important thing to know about your adjusted gross income, your AGI, is many tax credits, some incentives, some deductions even are limited or phased out based on your AGI. So that's why that number is important. Adjustments to taxable income that are above the line, student loan interest, again, it is subject to certain limitations and phase outs, but if you have student loan interest based on higher education loans, then that may be deductible. And the big one that we see often is, tax advantaged accounts, health savings accounts. If you are contributing to an HSA because you have a high deductible insurance plan, you're putting money away in a tax deferred account to pay for those medical expenses, that is an above the line deduction, again, subject to limits. Retirement accounts also, if you're able contribute fully to your 401k, contribute to IRAs, any of those types of accounts are very beneficial and they reduce your taxable income accordingly. Below the line, when we look at the standard deduction or itemized deductions, you're going to take the greater of the two. So right now, under the 2017 Tax Cuts and Jobs Act, the standard deduction grew quite a bit. So as we have here for last year, for your single filing, it's $13,850. You figure out what your itemized deductions are. If they don't exceed that number, then go for the standard. So really, you're going to take the bigger of the two. Again, be mindful though, state conformity. California didn't increase their deductions, their standard deduction that largely. So many people take the standard for federal and itemize for state. So just be very aware of that. And then some of the itemized deductions do have limitations on them based again on your AGI. So medical expenses based on 7.5% of your AGI. Anything above that is what's deductible. When they come back in after 2025, itemized deductions are subject to a 2% of AGI floor. So lots of nuances, lots of fun rules around them, but that's kind of the quick and dirty of it. Mike, do you have anything you want to add to that?
Yeah, just watch the top line there is that a lot of these provisions or the numbers are going to change if Congress doesn't act before the end of next year. Congress probably will act, but just a lot of what we're saying here today is going to change. In particular, that standard deduction,
Yes.
absent congressional action, will be cut in half starting after 2025. So just watch this space. It doesn't really impact you in thinking about your 2023 return. But there is going to be, there will be significant developments on that front going forward. So write your congressperson about the changes in the tax law. That's where things stand right now.
Right, right. Okay, let's move to the next slide.
And just as we transition, Bridget, I'm seeing a lot of very good questions come in on the chat, and I'm sorry we can't address all of those. There are a couple that speak to the issue of documentation and substantiation. Like, I received a gift of stock 26 years ago. I had dividend income many, many years ago. I didn't really keep track of it. What do I do with it now? Those are all very good substantiation questions. Probably not give you direct advice on that here, but those are certainly something that you might want to talk to a tax professional about, not use one of the online versions that Bridget talked about, because those can be very complicated questions. And there are some solutions to some of those documentation problems, but they're usually very specific to the personal situation. So, but a lot of very good questions coming in. So thank you for those.
Right. Thank you. Okay, great. Mike, do we want to just pinpoint the highlights on these?
Sure. Yeah, I think I had mentioned before a lot of tax expenditure provisions. So there was a very significant piece of legislation that came in August of 2022 called the Inflation Reduction Act, which has a number of new credits for clean vehicles, electric vehicles, plug-in hybrids, others. Also continued and expanded and made changes to a number of other individual credits in the clean energy space, solar roof panels, energy efficient windows and building components. So those are something to talk to a tax advisor about, but there are a lot of things to watch there that can help to reduce your tax liability. Another point here, there's some moving legislation on the child tax credit. That's just sort of a point about the sausage factory in DC continues to grind away on changes to the tax law, even in real time after we've already closed the 2023 tax year. So if you've got children and are thinking of claiming the child tax credit, watch that space. The other point, the last 3 bullet points there, is that during the pandemic, the IRS really took a very soft line on collecting taxes and basically suspended the issuance of most of the routine collection notices that it sends out. So it has recently announced that it's restarting all of that after a 2 or 3 year pause in the pandemic. Concurrent with that, they announced very significant penalty relief for a lot of taxpayers that hadn't gotten those notices, individual taxpayers. So if you've got past due taxes from years before the pandemic, something again to consult with a tax professional on, but there are a lot of developments in that space recently.
Right, absolutely. And on the identity theft issues, that's always been a large concern of most people, including the IRS, and they are committing a lot of resources for detection and prevention of identity theft issues. One of the things that they do that they highly recommend, and I highly recommend, is that you can apply to get an identity protection PIN or an IP PIN from the IRS. Once you apply for that, what happens is they send you a letter every year at the beginning of January with your new PIN. So your IP PIN is not yours for life. You get a new one every year, and it's just another way for them to make sure that the tax return that they receive and possibly the refunds that they are paying out are going to the correct taxpayer and not to somebody who's just pretending to be you.
So the next slide just has a few other recent and current developments. We talked about the provisions expiring at the end of 2025. We talked about independent contractors, people that are filing Schedule C with their tax return, Uber drivers, Lyft drivers, content creators, those kinds of things. There is ongoing developments relating to information reporting and legislation Congress passed that would lower the threshold for this Form 1099-K that's issued to many of those workers. That's a moving target. As I said earlier, it doesn't matter whether you receive a 1099-K or not. There's a very high threshold, or was at least prior to 2024. So watch that space, but there may be, at least in the coming months and years, a significant increase in the number of 1099s that people who are in that kind of gig economy are receiving. Also, there is legislation passed a couple of years ago and very recent regulations that would have a number of crypto exchanges, Coinbase and the like, issuing forms 1099 for transactions in digital currency, just like a Fidelity or Charles Schwab or a traditional broker issues for securities, traditional securities accounts. Those are all only in proposed form, but could be, if you are an investor in cryptocurrency or even play around with cryptocurrency, you may find 1099s coming your way in the not too distant future. The IRS, I think it estimated there's something like 8 billion 1099s might be issued under the rules as currently drafted. So your mailbox may be quite full in the coming years if those regulations get put in place as drafted, which I suspect they'll be cut back a little bit, but a very dynamic space.
Right.
Foreign financial accounts and activities, and Bridget, you can speak to this as well. That's always a focus of IRS activity. And I think for an audience like this, just be sure you're paying particular attention to some very complicated rules. If you or your children or friends are living and working abroad, even as a foreign exchange student or on a temporary assignment outside the country, a lot of very complicated rules can come into place about reporting your foreign financial accounts, income you earn in foreign countries, how that's reported. So an area, if you do have those types of activities, to be sure that you're consulting with a tax professional on, and you ensure that a lot of people get tripped up in that, and it's a very significant focus of IRS activity. Even a lot of recent criminal cases for people who are parking money in foreign bank accounts and thinking it won't be found.
Right.
So
and the penalties for non-compliance are severe, or $10,000 per occurrence. Just really egregious almost at times.
And I realize this is a pretty pointy-headed point, but for us tax lawyers, the Moore case, which is pending in the Supreme Court right now, is probably the most significant, or could be the most significant tax case in maybe a generation or more. is a very interesting case involving what it means to be subject to income tax under the 16th Amendment of the US Constitution. So if you, like me, are a pointy-headed tax lawyer or have an interest in that area, I encourage you to just Google the Moore case. You'll see lots of articles about it. It was just argued in December, and we should see a decision, but could have some significant impact on both very technical and even some broader areas of the tax law. So stay tuned on that front, but no need to worry about that for the most part for your 2023 tax returns. I would not let that keep you awake at night.
And then finally, Samantha, I see you're back.
Yes, I just wanted to give you the chance. We have a couple of questions, but I wanted to give you a chance if there was anything left on your slides that you felt was really going to be of some great value. Otherwise, we can switch over to some questions.
Yeah, I think we can definitely go to the questions, although I would like the slides to go quickly to the last one. We do have a couple, just one more after that one. We do have a couple different websites that are useful. So if you're looking for more information, you've got some questions, these are some great resources that are out there for you that have really good information. So I just wanted to make sure that everybody had that.
Wonderful. And we'll share that out as well with follow-up.
Thank you.
That last one in particular, I'll highlight that you can create an account with the IRS. There's an ID.me authentication. You can go and it will keep track of your payments that have been made, estimated tax payments. It will show if there's any balance due. So a lot of times mail doesn't come through very well and people aren't necessarily tracking mail, but that's a very good way to keep track of your current accounts with the IRS, and also the Franchise Tax Board has a similar, very powerful tool.
Absolutely.
Wonderful. We'll do just a quick fire round on some of the questions. First and foremost, if you are claiming someone as a dependent, do they also have to file their taxes?
The answer is possibly. So there are income limits. If their income is not earned income and it's below certain limits, that you can include any income that they earn on your return. But if their income limits are higher, they do need to file their own return. They need to mark that they are considered a dependent of another. And there are kiddie tax rules where they may also be subject to your higher tax bracket.
Wonderful. If you are receiving money as a stipend to cover expenses, for example, hosting an exchange student, how much of that needs to be reported as income?
Good question. I think the basic answer is that's going to be gross income, and you probably can't deduct the expenses because they're personal. So if you're spending food and a portion of your housing expense, so that's one of those things that's, the IRS doesn't pay a lot of attention to it, but gross income is gross income. So if somebody's giving you a check for $500, the starting point I would say is that's going to be includable in income. It's to Bridget's earlier point, you're not in the trade of business of hosting people. You're not running a hotel. So you probably can't deduct the expenses for that reason as well. But I think, and Bridget, you may have different views, that the starting point is that's going to be includable in your income.
Yeah, I agree.
And then I think we'll just round up with one more that we have time for. How long should you retain past tax filings and supporting records other than the permanent records you mentioned, like business laws and accumulated home ownership expenses?
So if I'm understanding the question, it's more of tax filings that they're asking about, of like actual tax returns.
How long should you retain past tax filings and the supporting records?
Really just as long as the statute is open, number one, and then number two is if they have information on those, that apply to future returns. So, I mean, I hate to say it, but it's better to hold them on a little bit too long than to let go of them too fast. What I found is that, banks have record retention policies. And so you might think that you can always go back to your bank or to Charles Schwab and get that 1099 that you need for something, and they might not have it anymore. So it's always good to err on the conservative side and, take up a little more space on your computer for those files.
Yeah, and it's so easy now to store things in a digital format that there's really no reason. It's not like when you used to have file cabinets full of documents. It's pretty easy to keep track of those. And there are also other reasons I've had over the course of my career, other reasons to go back. If you're borrowing, you might need to prove to a bank that you had income from certain sources. So independent of the tax system, there might be reasons why you need to demonstrate to someone prior income, expenses, questions like that come up. So But generally 3 years is the statute of limitations. So at a minimum, hold on to everything for 3 years. But again, I don't think there's any, if you can digitize things, scan them in, stick them in a folder on your personal computer, hold them that way, then hold them even longer. There's no real reason. And as I said, there might be other reasons why these become relevant in other aspects of your life, not necessarily relating to the IRS.
Wonderful. Well, thank you so much. There's so much rich content here this evening, and I'm amazed that we managed to get through it and stay pretty much on schedule. So thank you. I know there was just so much more we could have learned from you, but so appreciate you both participating in Gaucho Academy so that we can bring information like this to our community. And thank you to our alumni who have joined us today. And thank you again to our team, Julie, Arushi, and Shaknosa. And we will follow up with the recording of this session as well as the useful links, and that will be posted both on our website, and we'll send it as a follow-up email. So thank you for joining us, everybody, and thank you, Michael and Bridget. We so appreciate you.
Thank you.
Thanks, everyone. Go Gauchos.
Let's go Gauchos.